Traditionally, traders would buy low and sell high, known as going long, in the hopes that market prices will rise. Today, short selling, also known as going short or shorting, is a popular way to trade if you think market prices will fall. The aim? Sell high and buy low. But how can you sell something you don't own? Well, let's take Rio Tinto. Imagine it's trading at 93 Australian dollars per share. You think the price will drop, so you short sell 100 shares at a value of 9,300 Australian dollars. To do this, you borrow the shares from your broker. If the share price falls to, say, $90, you can buy back all 100 shares for 9,000 Australian dollars and return them to your broker. The difference, $300, your profit, less any fees or commission. But if the price had risen to $95 per share, for example, buying back your shares will cost you $9,500, and that would mean a loss of 200 Australian dollars plus costs. Remember, you always need to buy the shares back at some point, as they still belong to your lender. Trading derivatives, like CFDs, makes the process of short selling a little more straightforward. That's because you never own the underlying asset, so short selling is no more complicated than going long. So why do traders short sell? The obvious reason is you could get exposure to the market even when it's going down. In other words, bad news and price dips can become opportunities. Hedging is another reason why you might consider short selling. This is when you open a position that can counter adverse moves in your portfolio, offsetting your risk. For example, if you have long positions on several Nikkei 225 companies, you could use a CFD to short sell the index as a whole, which could reduce the impact on your bottom line if your Japanese shares start dropping in value. While short selling could have advantages, there are potential downsides too. The biggest risk you face when short selling is unlimited losses. If you go long on a share, thinking it will increase in price, the absolute worst case is it drops to zero. But when you go short, the price could rise indefinitely. This makes it important to use stops to limit your losses. So, the risks are there, but if you approach with care, the opportunities provided by short selling really can add another dimension to your trading.